What if the Bitcoin sitting in your wallet right now is more dangerous to hold the smart way than the boring way? What if the next major Bitcoin disaster doesn't come from a government crackdown? What if it comes from something millions of holders are doing right now? Not a hack, not a ban, not even a regulator stepping in. Something investors are chasing on purpose. Something marketed to them as the smart move, the disciplined move, the move that separates serious investors from people who just buy and forget. Bitcoin yield. Just one day before this video, on June the 16th, Michael Saylor, the man whose company holds more Bitcoin than almost anyone alive, quietly posted something on X that should make every yield-hungry Bitcoin holder a little uneasy. He didn't talk about staking. He didn't talk about chasing double-digit returns. He laid out something he calls the digital asset stack, 5 layers deep. And buried inside it is an argument that could change how millions of people think about holding Bitcoin for the rest of this decade. Because Saylor isn't just rejecting the Ethereum playbook. He's making the case that trying to force Bitcoin to do more might be the single biggest unforced error of this entire cycle. Stay with me until we get near the end, because that's where Saylor puts a number on the table that some analysts are calling almost reckless to say out loud. Once you hear it, the whole yield conversation looks different. Quick disclaimer before we go further. Nothing in this video is financial advice. This is a breakdown of public statements, on-chain data, and market behavior, so you can think it through for yourself and reach your own conclusion. If you're holding Bitcoin right now and simply letting it sit untouched, no lending, no staking, no yield farm, comment below and tell me why. By the end of this video, you might find out that decision was smarter than you ever gave yourself credit for. To understand why Saylor's framework landed like a bombshell this week, you first have to understand how investors have been trained to think. For decades, the rule has been simple. Your money should always be working. Stocks pay dividends, bonds pay interest, real estate generates rent. Even a basic savings account earns something. Everything is supposed to produce cash flow. So when Bitcoin showed up and started eating market share from every traditional asset class, investors asked the obvious question, where's the yield? It's not an unreasonable question. If a platform offers you an extra 8% or 10% or even something north of 11% on top of Bitcoin's own price appreciation, why wouldn't you take it? That single question built an entire industry. Lending platforms multiplied. Staking products expanded. Yield-bearing wrappers got slapped onto Bitcoin from every direction, even though Bitcoin itself was never designed to behave that way. Think about how normal this has become. Open almost any crypto app today, and somewhere on the home screen there's a button that says Earn. Tap it, deposit your coins, and watch a percentage tick upward. It feels like a savings account. It feels regulated. It feels safe. It isn't any of those things by default. It's a promise, backed by whatever the platform on the other end is doing with your coins behind the scenes, something you almost never get to see. Right now, one of the most talked about yield products in the Bitcoin world is Strategy's preferred stock offering, known as STRC, which currently advertises an annual yield near 11.5%. Saylor himself has called it a kind of safe haven instrument inside his company's broader capital structure. 11.5% sounds incredible, next to a savings account paying almost nothing. But here's the part nobody wants to sit with for more than a few seconds. That yield isn't coming from Bitcoin's protocol. It's coming from a corporate structure built on debt, equity issuance, and convertible notes, layered on top of Bitcoin as collateral. Which raises a much bigger question that Saylor himself is now asking publicly. If Bitcoin itself doesn't generate yield and never was built to, why are so many holders pretending it does? Because Bitcoin isn't a company. It has no earnings call. It manufactures nothing. It generates no revenue. Its entire value proposition is something completely different from every yield-bearing asset you've ever owned. It's also worth asking why this question feels so urgent right now, with Bitcoin trading just under $66,000 and the broader market still digesting a violent few weeks of swings. When prices move that much, the temptation to squeeze extra return out of every coin you own gets stronger, not weaker. Fear of missing out doesn't only apply to price, it applies to yield too. And that distinction is exactly where Saylor's new framework begins. Morning, afternoon, or night, wherever you're watching this from, here's the part that's actually new. On June the 16th, Saylor didn't just repeat his usual Bitcoin is digital property talking point. He laid out a structured 5-layer model he's calling the digital asset stack. At the base sits Bitcoin itself, pure, unmodified, the reserve asset. Stacked above it, 4 additional layers: digital credit, digital money, digital yield, and digital equity. Each layer is a financial product built on top of Bitcoin, using it as collateral without ever touching Bitcoin's core rules. Saylor's own words were blunt: Bitcoin does not need staking. Read that again, because it cuts directly against everything the broader crypto industry has been selling for years. His argument is that yield should come from capital structure, from companies and products built around Bitcoin, not from changing Bitcoin's supply, its issuance schedule, or its consensus rules. In his words, The stack does not weaken Bitcoin's core principles. Think about why that distinction matters so much. Every time a protocol introduces staking or inflationary rewards or yield baked into the base layer, it's making a trade. It's exchanging some of its certainty for some extra return. Bitcoin has never made that trade, and Saylor is arguing it never should. Instead, in his model, if you want yield, you reach for the layers above Bitcoin. Digital credit, meaning Bitcoin-backed lending. Digital money, meaning stable, liquid instruments anchored to Bitcoin's network. Digital yield, meaning interest-bearing products collateralized by Bitcoin, not minted by it. And digital equity, meaning ownership structures, like Strategy's own stock, built on a Bitcoin standard. Bitcoin stays the foundation. Everything risky sits above it, clearly labeled, clearly separated. Saylor has described it almost like a building. Pull the bottom floor out, or weaken it in any way, and the entire structure above it becomes unstable. Leave the bottom floor untouched, and you can build as many risky floors above it as the market is willing to support without ever threatening the foundation itself. That's a meaningfully different message than stake your Bitcoin and earn. It's closer to Bitcoin is the collateral. Everything you actually earn comes from products built around it, using tools like debt, preferred stock, and convertible notes. Saylor has previously pointed to exactly those tools, what he calls digital credit, digital equity, and digital capital, as the financing mechanisms his own company uses to keep adding to its Bitcoin position without diluting existing shareholders any more than necessary. Now, here's the part nobody is paying attention to yet, because the framework only dropped 24 hours ago. This isn't just a philosophical statement, it's a defense of a business model. Strategy needs investors to keep believing Bitcoin itself should remain untouched and pure, because that's exactly what makes their credit and equity products valuable in the first place. That doesn't make Saylor wrong. But it does mean his incentives and his argument point in the same direction, and you should weigh that as you listen to the rest of this. Hit like if this is starting to make sense, because we're about to get into why this distinction isn't just theoretical. It's already cost some investors everything. If the past few years have taught Bitcoin holders anything, it's this. Yield is never free. Not once. Not ever. Remember what happened during the last major cycle. Lending platforms promised attractive, steady returns. Money rushed in by the billions. Everything felt safe, right up until it wasn't. Platforms froze withdrawals. Companies collapsed almost overnight. Fortunes that looked completely secure evaporated within days. One of the largest crypto exchanges of that era filed for bankruptcy almost overnight, taking customer funds down with it. People who thought they were earning a few extra percentage points discovered far too late that they'd actually been unsecured creditors the entire time. The pattern was always the same. To earn yield, you had to hand your Bitcoin to someone else, and the moment you did that, you reintroduced the exact thing Bitcoin was built to eliminate. Counterparty risk. Bitcoin removes the need to trust a third party. Yield products quietly bring that trust requirement right back in through the side door. And this is exactly why this matters right now, not as some abstract history lesson. Just weeks ago, Bitcoin fell as low as roughly $59,000 during a sharp sell-off tied to escalating tension between the United States and Iran. Over $1 billion in leverage positions were liquidated in a single 24-hour stretch. The asset has since recovered toward the mid-60,000s, but that swing is a reminder of how violently this market can move. Are you positioned for moves like that, or are you just watching and hoping it doesn't happen to you? Even Saylor's own company isn't immune to volatility, despite the confident tone of the digital asset stack. Strategy reported an unrealized loss of more than $14 billion in the first quarter of this year, even while claiming a positive Bitcoin yield metric for its shareholders. Saylor's own response to that paper loss was 3 words. Not perfect, just better. Sit with that for a second. The architect of the Bitcoin doesn't need yield argument runs a company that posted a $14 billion unrealized loss in a single quarter, financed in part by debt, and preferred stock-paying double-digit yields to outside investors. That's not a contradiction that breaks his argument, but it is a reason to separate the philosophy from the company selling it to you. Do you think the system can hold if Bitcoin drops sharply again while billions in yield-bearing products sit layered on top of it, all depending on Bitcoin's price staying high enough to support them? That's the real risk. Saylor's framework is trying to manage, and it's the same risk every yield-chasing investor needs to understand before clicking deposit on any platform promising them an easy double-digit return. One of the more pointed parts of Saylor's argument involves a direct contrast with Ethereum. Ethereum was designed from day one to support staking. Validators lock up their holdings, participate in securing the network, and earn rewards for doing it. Yield isn't bolted onto Ethereum from the outside. It's woven into the protocol itself. Bitcoin was never built that way, and Saylor argues it shouldn't try to become that way now. Bitcoin's entire value proposition rests on 4 things: security, predictability, scarcity, and simplicity. 21 million coins, a fixed issuance schedule, and rules that haven't meaningfully changed in over a decade and a half. Ethereum made a different bet entirely. By building staking into the protocol, it gave holders a built-in reason to lock up their coins and support the network, in exchange for a return that comes from the system itself, rather than a separate company sitting on top of it. That's a coherent design. It's just a different design, built around a different philosophy of what the asset is supposed to be. Saylor's concern is that bolting an Ethereum-style yield mechanism directly onto Bitcoin's base layer would dilute the one thing that makes Bitcoin different from every other digital asset on the market: the certainty that the rules will never bend, no matter how attractive the short-term incentive looks. But this is where things start to break down for a lot of casual observers, because the distinction Saylor is drawing is subtle. He's not saying yield is bad. He's saying yield belongs above Bitcoin, not inside it. Ethereum chose to build yield into its foundation. Bitcoin, in his model, builds yield into the layers people choose to add voluntarily, while keeping the base completely untouched for anyone who simply wants to hold. That's a meaningful difference for long-term holders. It means you can choose your own risk level, hold Bitcoin directly, and you get pure exposure to the base asset, no staking risk, no protocol-level inflation, no smart contract risk. Or you can climb the stack into credit products, yield products, or equity products, and accept additional risk in exchange for additional return. The mistake, according to Saylor, is treating those two choices as the same thing. They're not. And conflating them is exactly how investors end up surprised when a safe yield product turns out to carry real downside. Subscribe if you want to stay ahead of what's coming next in this space, because the institutional side of this story is moving even faster than the retail conversation, and almost nobody is talking about it the way they should be. Here's where things get genuinely interesting. Wall Street appears to be drifting towards Saylor's exact philosophy, whether or not it's intentional. Look at where institutional money has actually been flowing. Spot Bitcoin ETFs just broke a multi-week outflow streak, pulling in fresh net inflows led by BlackRock's fund. On-chain data shows whales pulling more than 11,000 Bitcoin off exchanges in recent days, a classic signal of accumulation rather than distribution. And Strategy itself just added more Bitcoin to its balance sheet, lifting total holdings to roughly 846,000 coins, a position worth tens of billions of dollars at current prices, built at an average cost in the mid-$70,000 range per coin. Notice what institutions are not doing. They're not chasing exotic yield farms. They're not hunting for the highest advertised percentage on some obscure lending platform. They're accumulating the base asset directly, the same way a sovereign wealth fund accumulates gold reserves, not because gold pays a dividend, but because it sits quietly on a balance sheet and protects purchasing power over decades. This is where smart money is already moving, and it lines up almost perfectly with Saylor's framework, even from institutions that have never mentioned his name. Add in the macro backdrop. The Federal Reserve, now under its newly seated chair, just wrapped a closely watched policy meeting, with markets overwhelmingly expecting rates to hold steady. Tensions between the United States and Iran appear to be moving toward a resolution rather than an escalation. Both of those developments have already pulled Bitcoin back from its recent lows toward the mid-$60,000 range. What happens next is the real story, because none of that macro backdrop changes the underlying questions Saylor is raising. When institutions deploy billions of dollars, their priority isn't squeezing out an extra percentage point of yield. It's capital preservation. It's owning something scarce that nobody can dilute, freeze, or print more of. That's a meaningfully different mindset than the one driving retail investors into yield platforms over the past few years. And it's a shift most people scrolling through their portfolios haven't fully internalized yet. What would you do if this thesis actually plays out the way institutions appear to be betting it will? Would you still be chasing an extra few percentage points of yield? Or would you be doing exactly what the largest balance sheets on Earth are doing right now, simply holding? But this is where things start to break down a little, because even Saylor isn't pretending everything is going perfectly right now. In recent comments, he pointed to something he calls the AI summer, the wave of capital pouring into artificial intelligence companies and infrastructure plays, as a real force pulling money away from Bitcoin in the short term. He's openly said he expects that capital to rotate back toward Bitcoin later this year, once the frenzy around some of the biggest AI names starts to cool. He went further. He said, Bitcoin's next major leg higher depends on fresh capital arriving through credit markets, either through Bitcoin-backed credit products from companies like his own, or through traditional bank credit from major institutions. If the largest banks stay on the sidelines, in his own words, the coin stagnates. That's a genuinely uncomfortable admission buried inside an otherwise bullish framework. The same person describing Bitcoin as the foundation for a seven-figure future is also saying, plainly, that the next move higher isn't guaranteed. It depends on capital flows that haven't fully arrived yet, and on banks that haven't fully committed yet. Do you think the system can hold through a stretch where attention and capital keep drifting toward AI instead of Bitcoin? That's a real open question, and nobody, including Saylor, actually knows the answer yet. Here's the number I promised you at the start of this video. Just days before this digital asset stack framework dropped, Saylor stood on stage at a major Bitcoin conference in Prague and laid out what he's calling his Bitcoin capitalism thesis. Inside that thesis sits a price target that even some Bitcoin bulls consider aggressive: $7 million per coin, not as a guarantee, not as a prediction with a fixed date attached, as the long-run implication of Bitcoin becoming the base layer for an entirely new class of global financial products, the foundation underneath credit markets, payment systems, and ownership structures that don't fully exist yet. Whether or not that number ever arrives, the philosophy underneath it is the actual bombshell, and it's been sitting there the entire video. Saylor isn't asking whether yield can generate returns. Plenty of structured products can, including his own companies. He's asking a much bigger question. Why risk the world's hardest, scarcest asset for a few extra percentage points if simply owning that asset, untouched, already represents one of the largest wealth creation opportunities of this generation? If Bitcoin truly becomes the global reserve layer for digital capital, accumulated by corporations, eventually by sovereign wealth funds, and increasingly by pension allocators, then the largest returns may not go to the cleverest yield farmers. They may simply go to the people who held. That idea sounds almost too boring to matter. But across financial history, boring patience has built more durable fortunes than complexity ever has. And that's why this entire framework matters right now, not as a future hypothetical, but as a decision sitting in front of every Bitcoin holder watching this today. So, do you agree with Saylor? Is Bitcoin yield a legitimate opportunity sitting one layer above a rock-solid foundation? Or is it a trap dressed up in the language of passive income? Are you positioned for what institutions are already quietly doing, or are you still just watching from the sidelines? Let me know in the comments exactly where you stand, and what you think happens to Bitcoin's price if this digital asset stack thesis actually plays out over the next few years. If this video changed even slightly how you think about holding versus chasing yield, hit like so this reaches more people who need to hear it. Subscribe to the Wealth Continuum if you want to stay ahead of stories like this one before they hit the mainstream financial headlines. And share this with someone who's currently chasing a safe double-digit yield on their Bitcoin without fully understanding what they just signed up for. It might be the most useful 3 minutes you send them all year, because the next trillion-dollar mistake in this market probably won't be the people who never bought Bitcoin at all. It may be the people who owned it and simply couldn't resist trying to make it do more. We'll keep tracking how this digital asset stack plays out, whether the banks actually show up the way Saylor expects, and whether that $7 million thesis ages well or gets quietly forgotten. Either way, the decision in front of you right now is a simple one. Hold the foundation or chase the floor above it. Choose with your eyes open.